Hi there, hello everyone. Today I'm going to present before you a difference between PPI and CPI. PPI is Producer Price Index and CPI is Consumer Price Index. This is a very important concept in fundamental analysis, and forex analysts and traders need to understand the difference between the two. Both of them are US based economic indicators. So let's see what it is. Okay, Producer Price Index versus Consumer Price Index. Both PPI and CPI are important economic measures because they point to monthly changes in prices. Okay, but they reflect prices from different standpoints. Okay, fair enough. So let's see what is PPI. PPI is the Producer Price Index that measures prices based on the first commercial transaction for a product or a service. In other words, this is the price that the producer or manufacturer identifies while producing something or while manufacturing something. Okay, on the other hand, CPI is in contrast to the product producer price index, and CPI measures price changes encountered by the consumer. So CPI is basically from a consumer perspective, and PPI is from the perspective of producer perspective or manufacturer perspective. Okay, and both PPI and CPI are categorized as red news on forex calendar. That means that the forex traders need to look at them very carefully because there could be a market volatility based on the data release of both these indicators, so they can tailor their strategies accordingly and they can make money out of it. Okay, all right, so let's see their differences. So PPI Producer Price Index and then CPI Consumer Price Index. PPI is a measure of inflation at wholesale level from manufacturer's cost of input. Okay, while CPI is a measure of inflation at the consumer level. So both of these concepts are opposite. It tells us manufacturer's cost of input, and CPI tells us focus on the final sale or final consumption. Okay, number three, PPI is not as strong as CPI, and CPI is stronger inflation measure than PPI. Okay, and PPI is a forecast of future CPI releases, and on the other hand, CPI numbers factor in PPI numbers. So why CPI is stronger? Because when we calculate CPI, or when there is a CPI data release, then we also account in the PPI numbers as well. That's why CPI is more stronger than PPI, because PPI numbers actually feed into CPI numbers. Okay, fair enough. All right, so when there is a data release of PPI and CPI, then analysts are looking at the forecast and predicted figures ahead of the data announcement. So when we have the data release, so what is the possible output? So PPI and CPI data both, they can have either above expectations or below expectations data release. So in either case, there could be negative or positive effect on US dollar or US dollar driven markets. Okay, so what could be the possible outcome of the output of that red data? So either PPI or CPI data can be better than expected or lower than expected. So if it is better than expected, then there could be a strong US dollar versus other currencies, and if it is lower than expected, then the US dollar could be weak against other currencies. So what's in it for the forex traders to do? So for traders, trading the data can be an important yardstick, and they can analyze their spread betting or CFD contract for differences strategy. So traders can actually base their trading strategies on the data release of PPI and CPI. Alright guys, I will stop here. I will conclude. I hope you like the video. I will see you next time. Have a good day. Bye bye.